Imagine this for a second. Someone walks into a dusty neighborhood pawn shop carrying a gold ring. A few minutes later, they walk out with $75 in cash. Now fast forward just minutes later, halfway across the world. A massive multinational corporation raises billions of dollars from global investors. And at that exact same time, governments are borrowing trillions by issuing bonds that get snatched up by central banks all over the globe. On the surface, right, a local pawn shop and the gleaming glass towers of high finance seem like completely different universes. But what if I told you they are driven by the exact same system? Today, we're going to completely challenge a hidden assumption about finance. We are exploring how every single loan ever made, from that small personal pledge for $75 all the way up to sovereign debt financing entire nations, exists on one invisible, interconnected ladder of lending. And honestly, once you see this hidden hierarchy, you're never going to look at loans, banks, or governments the same way again. So let's dive right into this. The reality is, there's actually just one system. It's just operating at drastically different scales. Because whether you're hawking a watch, swiping your credit card for a coffee, or financing a multi-billion-dollar superhighway, the core mechanism is totally identical. You're participating in this massive global mechanism designed to move surplus capital from the people who have it right over to the people who need it. And that creates an invisible ladder that literally powers the modern worlds. Now, before we start our climb up this ladder, here is a quick note. This explainer on the channel Blocks Bonds Funds is created for educational and informational purposes only and does not constitute financial or investment advice. Okay, to really understand this ladder, we've got to look at its roots. Let's rewind the clock and trace the ancient origins of credit. Because lending didn't just pop up with modern banking, it actually started at the very dawn of civilization. Around 3000 BCE in Mesopotamia, they were using clay tablets to record debt agreements for agricultural goods. Long before coins were even a thing, farmers were lending grain and communities relied on pure trust. Fast forward to 650 AD and the Tang Dynasty, and we find the earliest evidence of pawnshops, with Buddhist monks holding items as collateral. Then, by the 15th century, the Medici Bank in Renaissance Europe pioneered double-entry bookkeeping, using credit to build this immense political and economic empire. And finally, in 1694, the Bank of England formalized national debt. So the takeaway here is that lending has always fundamentally been about one thing: transferring today's surplus into tomorrow's productivity. As we take our first step up, we hit the very first formal rung of the global credit ladder. And this is where we run into the massive distinction between a secured loan and an unsecured loan. A secured loan is backed by a physical asset, think property or jewelry. An unsecured loan, on the other hand, relies purely on a promise to pay, which is usually judged by your credit score. That neighborhood pawn shop, it operates on the absolute oldest form of secured lending. And what's brilliant about this is that physical collateral completely solves the fundamental problem of trust. You literally don't need to know the borrower at all. You just need to hold the asset. Let's look a little closer at the mechanics of these pawn shops, drawing on this really fascinating study of pawn transactions in Texas. The average loan size is incredibly small. We're talking just $79. The typical term is short, usually 30 to 90 days. There is absolutely zero credit check, no bank account required, and hey, no debt collection agency is going to harass you if you don't pay. That physical collateral drastically lowers the risk for the lender. But here's the truly wild part. Behavioral economics shows us that sentimental pledges, like a wedding ring, dramatically increase repayment rates. People actually use that sentimental value as a sort of self-imposed commitment mechanism to make sure they come back for their item. It's a remarkably robust, ancient system of microcredit. All right, let's step up another rung into broader consumer finance. Research out of the University of Bristol reveals exactly what consumers prioritize when they're stuck choosing between payday loans, credit unions, and pawnbrokers. It basically boils down to speed and access. For payday loans and pawnbrokers, consumers overwhelmingly agree they're quick to get and super easy to access, even if they strongly disagree that they are cheap. It makes sense, right? When you're facing an immediate liquidity shortfall, getting the cash in your hand right now is often way more important than worrying about the annualized interest rate. Now, as credit scales up to serve entire economies, Those personal ties and physical handovers get replaced by incredibly strict legal contracts and definitions. This creates a massive regulatory architecture. Suddenly, the law steps in to strictly categorize everything. We're talking credit contracts and consumer finance acts, rigorous definitions of high-cost short-term loans, and drawing the exact legal distinction between secured and unsecured debt. The latter is expanding rapidly here. It's no longer just two people making a deal in a dusty shop. It is a sprawling, legally codified industry designed to process millions of transactions every single day. And the sheer scale of modern consumer finance is staggering. Just in the U.S. alone, we are looking at $1.86 trillion in student loans, $1.56 trillion in auto loans, and over $1.27 trillion in credit card debt. That's enough money to make your head spin. Borrowing has basically been normalized as a mass market product. The whole architecture of modern life is constructed around this idea that you can borrow today against your future earnings just to participate in everyday prosperity. But the absolute crown jewel of all this consumer debt, that would be the residential mortgage. It's a secured, long-term loan using real estate as the collateral. To give you a sense of its immense weight in the system, data from a major European bank shows that residential mortgages can make up a whopping 56% of a retail bank's entire loan portfolio. It is the ultimate consumer loan. It literally chains families to decades of highly structured payments, while at the exact same time fueling middle-class aspirations of homeownership and building generational wealth. So what is all this debt actually doing for us? Well, legendary economists like Joseph Schumpeter and Hyman Minsky proposed what they called a two-price system, which highlights the critical difference between productive and unproductive credit. Productive credit is when a loan funds genuine new business innovation, fixed capital investment, or entrepreneurship. It creates real jobs and expands the economy's capacity. Unproductive credit, on the flip side, is when loans are just used to buy existing assets, like real estate or financial securities. That doesn't create new wealth at all. It just bids up the prices of those assets, which is exactly how we get massive financial bubbles. Let's climb up to the business rung and see how productive credit acts as the engine of business growth. It's a beautiful cycle, really. It starts when savers deposit their idle funds into banks. The banks then create new broad money by extending loans out to businesses. Those businesses use that funding to buy inventory, upgrade equipment, and hire new staff. This capital formation directly leads to jobs, innovation, and long-term economic expansion. This is the textbook, highly productive function of lending, taking idle savings and converting it into active, dynamic productivity. But what happens when a business grows into a massive multinational corporation? Suddenly, they need way more capital than a single local bank can safely provide them. Enter the syndicated loan. This is a massive corporate loan provided by a group of lenders, called a syndicate, and it's structured by specialized lead arrangers. It takes a simple two-party loan and transforms it into a global, international marketplace. This allows massive corporations to raise hundreds of millions or even billions of dollars, while perfectly spreading the risk across multiple, huge financial institutions. We actually see this exact same collaborative financing at work when it comes to physically building our world, like funding massive public infrastructure projects, highways, and hospitals. A special purpose vehicle, or SPV, gets created. It acts as the central financial hub, drawing in equity investors and those syndicated lenders we just talked about, and then directing all those funds to construction contractors and operators, all under a tight contract with a government authority. The complexity is absolutely immense, but the core function, it's exactly the same. Borrowing money today to build something physical that generates real value tomorrow. And now we are finally arriving at the very apex of our ladder, sovereign borrowers. This is where national governments step in as the biggest borrowers in the entire world. They issue debt to fund huge public investments, to stabilize their economies during sudden crises, and to build infrastructure that's meant to last for generations. At this level, they aren't just participating in the market anymore. They are literally defining the market. To truly wrap your head around the scale at this apex, consider this number. $31.4 trillion. That is the combined assets projected to be held by the world's top 10 central banks in 2026. Let that sink in. This is a concentration of sheer financial power that is larger than the GDP of the United States and China combined. Through their massive balance sheets, these institutions are quite literally governing the monetary conditions for all 8 billion people living on this planet. They exercise this incredible power by setting benchmark policy rates. Whether we're talking about the Federal Reserve in the US or the Bank of Japan, these rates act as the gravitational pull for the entire financial universe. When central banks adjust these rates, even slightly, they instantly influence the cost of borrowing on every single underlying rung of the ladder we've just climbed, all the way from those massive corporate syndicated loans right on down to the interest rate on your personal credit card.
So, how exactly do governments and megacorporations actually do all this borrowing? They use bonds. And honestly, here is the big secret of the financial world. Bonds aren't some super esoteric, mysterious financial product. Not at all. They are simply the highest, most sophisticated evolution of a loan. In the primary market, governments or corporations sell newly issued bonds directly to investors to raise cold, hard cash. Then, in the secondary market, those investors just trade those bonds among themselves. It takes the very simple concept of an IOU and turns it into a standardized, highly liquid security that can be traded globally in mere milliseconds.
Now let's tie it all together and connect the very bottom of our ladder straight to the top. Remember that pawn shop? It had a physical pledge, a bilateral negotiation, and direct custody of goods. Now compare that to the shadow banking repo market, where literally trillions of dollars are exchanged overnight. In a repo transaction, a borrower gets cash in exchange for securities, like those government bonds we just talked about, which act as the collateral. It's called a repurchase agreement. Economists have noted that these massive, complex repo markets operate on the exact same enduring logic as a medieval pawnbroker. By using collateral, you completely avoid the need to constantly obsess over assessing the borrower's credit. It is simply collateralized lending, just scaled up to the multi-trillion-dollar level. So the absolutely crucial point here is that there is a universal logic of risk that perfectly organizes every single rung we've looked at. Pawn loans depend entirely on the value of physical collateral. Mortgages depend on the appraised value of real estate property. Corporate debt depends on a company's projected future cash flow. And sovereign bonds, well, they depend on a government's taxation power and overall economic output. But at every single level, factors like creditworthiness, liquidity, maturity, and the probability of default dictate the terms. It's the exact same mathematical logic, just applied to very different types of promises. When you finally step back, you can see this complete, beautifully circular ecosystem flow. Your everyday household savings enter the system through bank deposits and pension funds. Financial intermediaries then step in to batch and scale those funds up, utilizing that massive pooled capital to issue global loans and buy bonds. And that capital goes out into the world and finances the very infrastructure, healthcare, technology, and trade that our modern society completely relies on. So in a very real way, your ordinary household savings are literally building nations and powering the global economy. As the Explainer Channel financial historian put it so perfectly, debt requires no factory, no inventory. It generates wealth out of time itself. Financial institutions exist merely to move capital from those holding a surplus to the creators of future value. It's not just some dry financial arrangement. It's an incredibly powerful, almost magical mechanism for actually manifesting the future. And what we are ultimately left with is one seamless global network. Just picture a glowing web of credit stretching across the entire earth. A $79 pawn slip secured by a dusty gold ring, and a $50 billion sovereign bond secured by the future tax revenues of an entire nation are fundamentally the exact same relationship. They just exist at different scales, with different risk profiles and different marketability. It's all one ladder. Modern civilization isn't actually built just on money. Money?
Money is just the medium. Modern civilization is truly built on this invisible ladder of lending. It is this hierarchy of credit that efficiently channels humanity's surplus savings directly into human growth, into bold innovation, and into our very survival. It is, without a doubt, the true lifeblood of the global economy. So I want to leave you with a really provocative thought to chew on. The next time you casually swipe your credit card for a quick cup of coffee, or you sit down to sign a piece of paper for a new car loan, I want you to ask yourself, which rung of this massive global ladder are you currently standing on? And more importantly, whose future are you actively helping to finance today? Thanks so much for joining me on this climb. Keep questioning everything and keep learning.